gentlemen, a big hello and a very warm welcome to yet another high impact Leaders of Tomorrow eForum. Today's focus is on alternative financing solutions for MSMEs. We all know that banks have strict criteria for approving loans, and small business owners can find it difficult to raise funds for their company if they choose to go the traditional way. Over the last few years, we've seen the emergence of alternate funding solutions that have easygoing credit requirements and flexible terms that can be tailored to meet individual needs. We've also seen alternative lenders work with companies that have gone through ups and downs. On that note, let me introduce to you my expert panel. I have Vinay Mathews, founder and COO Faircent, Sampad Swain, co-founder and CEO Instamojo, Mithun Sundar, CEO LendingKart, and last but not the least, Ajay Srinivasan, Director, CRISIL Research. So let me kickstart and get an umbrella view from you, Vinay, on the landscape of alternate financing solutions to available in the market and the difference between them.
It's important to understand first why is it the banks are not able to lend to micro SMEs. It's not that they don't want to. It's just that and we are trying to kind of fill that void. Instead of filling that void, it's important to understand why is it that the banks themselves not lending, because they also have the technology. So they don't lend to micro SMEs where the loan is, let's say, 50,000 rupees, a lakh rupees, primarily because the costs don't add up, with respect to the requirements they have. Okay? That is one reason. Second reason is that they cannot lend beyond a certain rate of interest, okay, because they have CRRs to maintain, all of that. So if the customer is a little riskier than typically what a bank would lend, chances of the banks not lending becomes a problem. Okay. Also, what we've realized is that banks use technology not to mature the customer journey, instead use the technology to better their processes. Okay. So for the existing customers that they have. Okay. So that's the reason I think primarily banks are not able to kind of go out and lend to large micro SMEs. So in the last 5-7 years or thereabout, there was this void, and this void fintech were trying to kind of fill. And it's important to understand that structurally, you have to be different in terms of to fill that void, because a lot of people are trying to do it, but they're not able to scale to a level. Some of these guys get line of finance from the banks itself or from large funds, but they're not able to kind of scale to a level where a Bajaj Finserv or an HDFC of that kind of come to that level, right? So that's primarily because there are certain fundamental things structurally fintechs are not able to kind of get it right. Okay, so one could be can you lend 500 rupees and still make money? So if you're doing that, I think your technology is working. Okay? Can you lend to 350 cities with one office? Let's say in Gurgaon. Okay, can you do a faster and a cheaper job? Can you do a daily loan? Give it in the morning and take it out in the evening and just charge 120 rupees. Okay, if you can do any of that, then you can classify yourself as a fintech. Okay, because clearly banks are not able to do it. Okay, they cannot lend 500 rupees and make money. Okay? So the other way to look at it is that banks, fund a lot of money to the microfinance companies. Okay, structurally, microfinance companies are different. So there is a way it goes out, and there is a way it is structured, and that's the reason banks are comfortable to kind of lend it. So similar structurally, I think fintechs also have to play out. If that structure is not in place, I think this will not scale.
I have a bit of an agreement, but a bit of a counterpoint. What I meant was, I agree with Vinay in the sense that banks do not lend sufficiently to MSMEs, right? There are 60 million MSMEs in this country. The ones which are served from a true working capital need is typically only 10 million of them. So there's another 50 yet to be served, right? And including all of the fintechs. But for me, it's less that they cannot, it's more that they do not need to. And there is a difference there, right? India is a large country, and just serving specific niches in the market is large enough to build 10 billion valued banks across the spectrum, right? There are folks who have specialized purely in auto loans. There are others who are specialized purely in property. There are others who are specialized in personal finance, right? The need to go deep in MSME in order to build a big company is not existent.
The banks are very comfortable lending secured loans. Okay, they are not very comfortable in unsecured, part of it, and that's the reason in credit card penetration in this country is around 2.5-3%. Okay, the personal loan penetration is there could be around 7 to 8%. Okay, within India, a target of 3 trillion economy, these kind of credit penetration is nothing. Okay, so that's the fundamental of basic credit any institution can give to an MSME or any individual, a credit card. So that itself is a abysmal, 2.5% or maybe 3% at best. But if you look at on the other side, secured lending, there is a whole lot of lending happening, right? So there is no problem there primarily because you don't need any science around that. Okay, you kind of put a collateral and back that collateral, and based on that you can lend. Okay, so the problem is on the other side. A whole lot of people don't have collateral to give. Okay, and you need to kind of bring them up the curve so that you're able to kind of lend them and get the employment within those MSME grow. That's how the nation grows. All of that is linked, right? So all of us know that. Fundamentally, I think there is some supply side problem, and that's the reason this entire structurally, this is a a concern. Okay, so this money is being controlled by 150 or 56 banks. Okay, and that's where even the NBFCs are looking to the bank to kind of get their line of credit. All of them are looking at the banks to kind of get their line of credit. So structurally, they're controlling the money. Is there a way an alternative supply can come into play? And this alternative has to be not from the banks, but somewhere else. Okay, maybe directly from the people. Okay? And that's where peer-to-peer lending comes into play.
Hold your thoughts there, Vinay. Let me just go to Sampad. I would ideally like you to explain the different forms of alternate financing. But correct me if I'm wrong, there is crowdfunding, P2P lending, which I believe Faircent is a P2P lender. You have invoice discounting, fintech lending, of course, venture capital, angel investments, and of course, private equity funding. Can you explain the difference? How does it differ in terms of getting a loan from these, avenues versus, let's say, getting a loan from a traditional bank?
Primarily, so all new form of lending comes with three kind of tenets, right? So either in terms of capital that you deploy. So somebody is giving like 1,000 rupee loan to a 1 crore rupee loan. So amount differs. Then tenure differs. Like we have loan from 2 days to 14 days, right? And some guys have 3 months to like 3 years, right? And then the interest rate differs, right? And this trifecta defines pretty much every kind of loan modality that kind of exists any market. And India obviously is kind of fronting that because of the requirement there is externally beyond the banks, right? Just to kind of extend that thought, I think two very interesting asset classes got created in the last 50 years. So obviously one is the bank, which obviously have been known to kind of give large working capital loans primarily secured. And the other is obviously venture capital, which most of us in the panel are backed to a large extent, right? All of us in some form of factor across the three parameters with interest rate, tenure, or amount are trying to create new modalities of loan for different sectors, right? So we cater to mostly primarily micro SMEs, right? So they're individual to up to like 10 people organization, right? I'm guessing Mithun would be doing like slightly larger and somewhere in between is where Vinay does as well, right? What we're trying to do, and that's one point I wanted to add, which I guess my colleagues kind of missed out. What fintechs brings to the fray is the ability to underwrite people, customers, without seeing them or meeting them, which you kind of ability to underwrite them with data and the latent data that hides, which all of us love to use, the machine learning algorithms and so on and so forth, right? What I have seen in the last 6 months prior to 6 months back, which is pre-COVID, is MSMEs are going online, coming digital, and there is a larger footprint that is getting created, and it will be far and few between, and more will be created. We will have additional capabilities to underwrite loans. And as you underwrite more and more loans and we're able to kind of get back the loan, our ability to create different tier of loan across amount, tenure, and interest rate will germinate, right? I think we're at a cusp, at a very interesting juncture where all the parties involved and outside as well, the fintechs would create very interesting kind of loans and super excited about it.
Ajay, let me bring you in. If you look at the total universe of MSMEs in India today, how many MSMEs are actually digital savvy? and are aware, have the acumen and the awareness of the availability of, non-traditional loans, such as, what we're talking about?
I think if you look at the overall landscape in India, there are close to 63 million MSMEs who are registered, and roughly about less than 10% of them have access to formal funding of any kind. So the quantum we are talking about in terms of the opportunity itself is so huge that one can only fathom that if you're able to underwrite these loans better, what could be the opportunity? The biggest challenge, I think, one is definitely awareness. I think there is a lack of awareness amongst a large section of MSMEs of the options available for them. Therefore, you have this money lender model which is prevalent, where you lend 100 rupees in the morning and you get 101 rupees in the evening, and you don't even know that what is the kind of rate you're paying, right? If they're able to create a product around it, structures around it, formal structures, I think that's a huge opportunity. I think the first part of this equation is to get the information and knowledge ecosystem right, so that MSMEs are aware of what is there in the market. The second leg is how do we use technology and data effectively to be able to serve the segment in a cost-effective manner, because you can't charge rates which will actually kill the MSMEs. So I think when I touched upon that, I think the cost of underwriting, the cost of collections, etc., is so huge that it all gets built up into the cost. So ultimately, I think if you are looking at how to resolve this issue, I think you have to look at data, technology, and awareness as three critical tenets. And for that, I think we need to incentivize, we need to make sure that MSMEs jump onto the digital bandwagon. The moment you have more information available, right, amongst MSME or of the business of MSMEs, the cash flow of MSMEs, the so-called premium which lenders charge for information asymmetry, right? Because you don't understand the business of the borrower, so you are trying to build it into the risk premium. Uh, that also will come down, which will actually create a virtuous cycle. So maybe we are still some years away from that, but we are very hopeful that given what we are seeing in terms of technology, the day is not so far that our access to credit to MSMEs will improve.
Mithun, if I could take this forward, the fintechs and alternate solutions, funding solutions have taken center stage in the last 5 to 7 years. However, the whole COVID-19 crisis has rocked the system, and if one has to go by the theory that that this model relies on the stability of the underlying data to predict a customer's so-called default probability. Would you say that this crisis is, has made this even tougher, given the fact that now you have delay in GST data, non-availability of the moratorium information with the bureau, and let's say other income challenge which you cannot actually go by? How difficult is it to assess whether a micro or or small or medium player is worthy of that loan or not? Isn't underwriting becoming a very big challenge in the short to medium term?
The one thing we do know about COVID is that at some point it'll pass. Whether it'll pass in 3 months, 6 months, 12 months, I don't know. But at some point you will have a solution and it'll pass, right? Now that's the only thing we know for certain. Then you have to answer two questions. Once COVID passes, do you still bet on the growth story that India has? That's number one. And if you do you also bet that that growth story will likely be credit-led? If the answer to both is yes, right, which I think is more or less obvious, right, because given the consumption pattern, given where we are, and the fact that credit will need to drive it, if the answer to both of those is yes, then I can answer your question. We used to have, I think, registered number of NBFCs in March of this year or February this year was about 10,000. When I last checked around July, August, that number had dropped to 7,000. What this basically means is that when you come out of COVID, there will be a massive flight to quality. There'll be a few people who have figured out how to manage in this dynamic environment. And those few people will actually be able to both serve the customer need well and grow dramatically. We will need to invent ourselves and we'll need to make our credit algorithm a little better. And whoever does it well will be the winner. So I see it as a mild, medium-term challenge. But given the flight to quality, I actually think it's a big opportunity because the number of NBFCs who come out of COVID successful will be a few, but those will do really well if we assume that the India story is positive. That's how I see it.
Ajay, if you had to, assess the alternate financing landscape currently and look at, yes, when everybody is talking about, yes, there's so much opportunity and it's bursting from its seams and this all, and all of that is great. The point is, today banks, traditional banks, are risk averse and have some trust deficit when it comes to this large sector for a reason. Do you think, in their initial enthusiasm, a lot of new players in this space are not looking at the fundamentals, are not doing their due diligence, and hence there is somewhat misplaced optimism?
I think I would not say that there is a misplaced optimism. I would say that everyone realizes that there is a cherry to be had at the end of the day, and everyone is trying to look at how they can perfect and fine tune their business models to be able to capitalize on the opportunity. And what, like Mithun rightly outlined, is that along the way, I think there will be refinements, there will be change in approaches which will be required. For example, after COVID-19, everybody is re-looking at the underwriting model, right? What needs to change, because it's a discontinuous change, and no one really knows whether this trend which we see of digitization is going to stay after 1 year, 2 years. Is it a structural trend? Is it something which will rise and then start tapering off? So there are a lot of these questions which are still not very clear. But what is very clear is that traditional banks would find it extremely challenging to be able to cater to the small ticket size MSME lending of the kind we're talking about. And therefore, alternative modes will have to come from the non-banks. And therefore, you're seeing banks, rather than doing things on their own, they're open to looking at partnerships, they're open to look at co-lending, they're open to look at how they can work along with technology companies, fintechs, and other data sets and information utilities to be able to really capitalize and see as to how to really play the game. But I would say that there is no misplaced optimism actually. But yes, I would not say that all the players who are in the so-called alternative lending model will actually see through it. I think there would be obviously cases where companies are not able to grow beyond a point, face challenges. But those who actually are able to perfect and fine tune the business models will really come out stronger.
Let's talk about what this model is going to be. And while everyone is still figuring out what that model would be, would it be right to assume that it can't be completely tech driven, with absolutely no feet on the street, and it can't be something as traditional as how the banking system how a traditional bank currently works? Can one assume it has to be a hybrid model where there'll have to be, of course, it will be tech enabled, but there'll also have to be feet on the street to ensure that there is some amount of interaction required, whether it is in terms of recovery or it is even in terms of onboarding?
I used to work in e-commerce before financial services. I used to run revenue and operations for Myntra, and about 70% of our sales came from tier 3 and village towns, right? And these are people who have a completely digital experience, except for the final guy going and delivering the parcel to them. And even that was done through a tie-up with sort of stores nearby. I have no reason to believe that financial services cannot give a 100% digital experience as well. Now, will it solve for all 100% of my customers? May not be. But I think 90%, and we give loans somewhere, our average loan size is about 7-8 lakhs given to MSMEs. 70-80% of our MSMEs are proprietor led, and the proprietors are often graduates, right? And this might be tier 3 and smaller towns. There is no reason why sourcing needs to involve, a touch point, because they are sourced through regular internet advertisements or search. The underwriting can be completely digital because I don't need to be in their place for me. I'm not looking at what outfit they're wearing or what their shop looks like. I'm just looking at their banking records and their tax records to be able to underwrite. Disbursal can be, KYC is now 100% digital, and the government is pushing for that. And disbursal can be 100% digital. Potentially, the only thing I need feet on the street for is, should there be a default situation, I need somebody to go and at least knock on the door to collect. Even that is theoretical, because if you underwrite well, all of these people understand what it means to have a credit record, and you have pretty solid sort of dependable, predictable outcome. So my sense, Sonali, is actually the reverse. We will move to a place where, at least for the MSMEs in this country, I think an ability to get 80-90% of them to be fully online digital journeys for their working capital loans can really happen. We'll need to fast forward a couple of years, but that's where I think the true opportunity is.
When can we expect in India to get credit at 3 to 5% interest as against today's rates of 10 to 18%?
Interest rates are a function of the cost of funding in an economy, and as we are all aware, I think till you have such a large government borrowing program which continues to keep a lid on the interest rates, right? You will not see that scenario in India. I don't think so. We are looking at that scenario in India at least over the next decade. Even the government borrows at close to 6%, right? So where is the chance for anybody to borrow 3 to 5%? Secondly, I think we have managed to at least maybe control the inflation problem. I think for interest rates to be 3 to 5%, you need to be a low interest, low inflation economy with limited government borrowing.
Let me put a positive spin to that question. I think if you're in a high growth economy where consumption is rising and disposable incomes are rising, by definition, aspiring for that to be a low interest, low inflation economy, I mean, low is a bit of a misnomer. I don't think it'll work. You will have some level of medium managed inflation and the right level of interest there.
So we are in a business where we get lenders directly to lend to borrowers. So for us there is no cost of capital, right? So technically, people can lend amongst each other at 0%. Okay, if they want. For example, Muslim brothers can lend and borrow amongst each other at 0% because interest is haram in there. So if a large amount of money is in CASA, right? So that's where the banks pick up and starts to lend, right? So within that, if you look at a very small percentage is in the fixed deposits. Okay, most of it is in the current account and savings account, right? So there you don't get any interest. Okay, so if you have a system by which you can move that money, and get that money 6% or 5%, and get it back again whenever the the person requires that money, you can have a system by which you can deliver that as well. Okay, so it can only happen if that works on a peer-to-peer network. Otherwise, it will not happen. The moment the money changes hands, so for example, if you're giving the money to the bank has cost. Okay, so there is a cost of capital from the bank side. So it's going to give out to anybody for that matter. It will be 6-7%. It'll start to kind of give out to. Okay, so there will the moment it changes hands, the more hand it changes, the cost goes up. But if you can get it from people to people directly, you can make this work.
Can Indian MSMEs not have a business credit score to reduce the risk and provide more loans to MSMEs with a good record?
Today, I think any MSME which opts for a loan from a formal financer, whether it's a bank or NBFC, right, they get deported to the credit bureaus. So if you have taken a loan from a formal financer, it automatically there's a footprint created in the bureaus. And that is one of the key things which anyway lenders look at while taking a decision, notwithstanding the current situation of a standstill in the bureau score. But I would say that if you're an MSME with a good credit history today, there are enough options available for getting funding.
Okay, fair enough. Does anybody have a take on that?
See, I'll give an analogy for that, right? Today, the laws that are made in the land are typically the laws for the lowest common denominator, right? I mean, you can take more or less anything. If you want to take vehicular safety, people are asked to wear X and Y because it is for the one person who might be very rash that all the other 99 are actually taking a whole bunch of other rules into it, right? That's how laws are framed. Now, what this person, and there's a law and sort of, common rule of the land. I'm just using a metaphor over here, but when the person goes to a bank to try and get an extension on the OD, the bank says, hey, I have, on an average, my NPAs from MSMEs are X, and so I can only give you so much of an OD. It's a similar conversation with the fintech when he goes and asks for on an average, MSMEs perform at this risk reward percentage, and so this is the rate of interest I can offer you until I know more and more about you specifically as an individual, which is difficult to know at that, which Ajay's point is right. Over time, with history, you do have a bureau score coming up, and the bureau score allows you to keep on getting better and better outcomes over time. So and the score is actually individual, not a group. But that's kind of how I see this play out.
Okay. Let me take another one. This gentleman says that I am chairman of an advisory board of the SME Federation, where some members have been complaining that when they go to a bank, and this is not necessarily the big banks like HDFC or ICICI, but smaller banks, the first thing you have to prove is that you have money before you can ask for money. He wants your comments.
So that's the irony, So it's very difficult to, the way the rules and regulations are made, for lending in this country. It's very funny. So I'm not from the financial services background, but to me it looks very, very funny. So I'll tell you what. So on one side, they say that the rates are lesser from the banks, okay, and the fintechs are charging a lot of money, okay. But if you look at it literally, you just try and roll your credit card 1 month, you end up paying 50%, including GST. So if you look at it, it looks very. So on the secured side is all fine, okay. But the moment unsecured, there is lack of clarity in terms of what this guy is, what his business is. So those information is very, very important to kind of pick up, okay. So if you don't have the ability, and if you have not, build your customer journey, with those capabilities, I think it's very, very difficult to kind of turn the customer down like that. So the only way to kind of say is that, get me some money and show me some money, only then I will lend money. So that's very, very funny.
I'll add to make it simpler. I think it's when you give money to someone, you look for two things, right? I mean, anybody, bank, NBFC, what you look for: one, intent, and you look for two, capability, right? Intent to repay, capability to repay. You can look for intent through a bunch of proxies, right? Has there been a default in the past? What's been their history? What is their bureau score? What is it? All of that. Capability, you need to have a certain sophisticated algorithm to look at their business and understand whether that business is able to repay this kind of an EMI over the next several months. In the absence of an ability to test either intent or capability, your proxy is you ask whether you have money or property or something in order for me to underwrite. It's a question of the capability getting built here to either test intent and or capability. And this is what, that is the opportunity for a lot of fintechs, including a company like mine or one like Instamojo or Faircent. The opportunity to be able to create that capability within us to test for the borrower's intent and ability to pay back is why we actually have an arbitrage at all.
Why credit cards or term loans are bundled to repo rate, which is 4 plus 100% profit margin equals to 8% MRP, as fintech is having leverage of low operational cost.
There are real costs. We are aspiring to make them as streamlined as possible so that we don't build legacy costs like banks have. There are real risks because you're doing it to a person with whom you have decent amount of information and you've developed your intelligence, but you don't have perfect information. In order to cover both of those, you will have some level of costs added, and there is a real cost of funding. It's not like I have depositor money which is coming in for free. I am borrowing in from other banks and from NBFCs and stuff. So it's a real cost of borrowing. I do have to cover these three to be at least a break-even institution, leave alone trying to make a profit.
I think there is the best you can do is that if you can get this on the peer-to-peer network, so you can get loans. Individual people can get loans as low as 10%. Okay? That's the best that we could do. Okay. Now, and we've lent out to quite a few of them at 10%. They should be good customer, the bank's customer. So SDFC bank customer getting at 14%, we're able to deliver that at 10%. Okay. So lenders the retail lenders exactly know this guy is a good guy working in good organization with good stability, good intent, intention. All of that is fantastic, and the data looks beautiful. He's ready to kind of park his money at 10% because his money is giving him 6% or 4% or whatever. So for him to flip it out to kind of make some extra 4% is available. But structurally, I think if you can do it, I think you can at best do it at 10%. The moment it kind of you try to kind of bring it down to 9%, then there is a comparison between government bonds, this bond, and all of that happens. So it's difficult. First of all, there's an onboarding cost, then there's an operation cost, and there is a collection recovery cost, and there is a legal cost. So all of this cost has to be borne by the fintechs or any company which is doing a lending business. Now, if you're doing that, you can use technology and at best get that cost down to 4 or 5%. Traditionally this was around 7 to 8%. But still there is cost. And you have to kind of make sure that you cover that cost when you're onboarding a customer.
If I had to ask you today, in this journey where we stand today, what would be some of the biggest challenges that we will have to overcome in the next year or two to further give momentum to this journey? What would they be?
Yeah, from my vantage point, the only challenge is KYC, right? Like, what's the actual regulation? So that's a question to my fellow panelists in the broader world. What is the actual regulation of eKYC? What is it? Like, I to be very honest, it's flimsy. Like, it keeps changing, and I can appreciate the reason why it keeps changing. But I think to kind of pinpoint the answer from my vantage point, it's the KYC rules and regulations, right? For example, if Mr. A wants a loan of say 100 rupees, and via our app he wants it, it's not that easy, right? Like, so I think that's a legacy issue that banks have traditionally dealt with. For fintechs like us, we kind of find it extremely challenging, given you to keep our operational costs low so that you can keep a credit cost down and everything else. So that's kind of a quick liner answer, that is KYC from our vantage point.
So what are you saying, that you would prefer the KYC to be a lot more detailed and robust?
No, it should be easy as eKYC. No, we're not talking about I'm talking about that we have an Aadhaar KYC, right? Obviously, that kind of got annulled and multiple iteration kind of came out. I'm saying KYC should be, I want to avail a loan. I have certain government documentation. Unfortunately, in this country, I have 10,000 documentation that I need to furnish. Aadhaar was a very practical way of identifying individual, right? And so we want a much simpler, straightforward KYC norms, which is applicable across the board, right? And hence the word eKYC. Unfortunately, the E is never taken into account, unfortunately. So it's just KYC.
Okay.
Okay.
That would be your biggest issue right
Hurdle
now.
for us. Yeah.
I'll give you a simpler, I mean, my view is a little simpler. I think I would ask for a few things. Number one, I would ask for, I think the government is already pushing for it, but to reduce friction on data more and more and more. Something like, what's happening with account aggregators, a step in the right direction, but you need to be in a place where with a couple of clicks, all data transfers can be very frictionless. One aspect of that is eKYC, right? eKYC is one of the data transfers where I'm able to explain who I am in a simple, easy, quick manner. Similarly, give access. That's number one. Number two that I would ask for is consistency. I think most banks and NBFCs have spent the last 6 months every week trying to figure out what the new rules and regulations are. I think I should say we've figured it out. Let it stay this way for the next 6 months, and let's now go and operate. So it's been very busy, and I would ask for reduced friction and information pass through. And number two, sort of more consistency would be the two things that you can ask for incrementally. The other things, which are risk, return, etc., has to evolve as the economy evolves. You can't just sort of put that out as an ask.
Okay, for us, I think it is awareness. Okay, so alternative lending, we are an alternative lending platform, completely alternative lending platform. So for us, I think the awareness is the most important. I think one of the challenges. Clearly, the benefits are very, very clear. Okay, so on the borrowing side, the loans are cheaper and faster. Also, we are a young population, and a whole lot of them, want unsecured credit. We have an internet population which is booming. So the infrastructure is ready, for that matter. And micro SMEs, I think is an important piece in the nation growth. Okay, so the government will have to support this. On the lending side, it is again very, very beautiful. So for us, I think the tech plays a huge role in terms of the transparency. We have some golden rules, the way the banks operate. We have put the same rules for our lenders. So that there is fractionalization. There is, for example, if you have spending a lakh of rupees on my platform to pick borrowers, you don't put that lakh of rupees to one borrower. So that money breaks into small units. So you can pick up a borrower as small as 500 bucks. So your money or a lakh of rupees goes out to pick up 200 borrowers. So that's fractionalization. Distribution, we operate out of 350 cities. And we have different kinds of loan products. There is microfinance loans, there is micro SME loans, there is education loans, there is salary loans, different kinds of loans. Okay, it is less volatile. A low ticket size investment. Supply side infrastructure is beautifully developed. You have large resellers selling mutual funds, insurance. You could just ride that big wave of the supply side infrastructure. And also we see that people want to give it back. A lot of people that we see on our platform come invest to give it back to the country, give it back to people, because they've made enough. Okay, And the last thing I think the government should bring about is, creating tax breaks for these investments, okay, which is a precedent which happened in the UK, Singapore, and some parts of Europe. People who are investing in a P2P environment to a micro SMEs, okay, any interest that they make out of that is tax free, okay. We saw that in UK, and it just went to a different level. So you don't, awareness does not mean that you have to put out full page ads in Times of India, okay. So you can create certain things, in some interventions which will make sure that your journey is completely moving to a different level.
What is the compounding average frequency of LendingKart and Faircent, and what are the rates?
We operate between 10% to 36%, because we are a company which can risk price the borrowers. We don't have a CRR or any of those to maintain, so we are able to kind of onboard some riskier customers as well. And we've created a model around that to kind of make sure that it gives return to our lenders. It's not that just because you're investing in 36%, you make 36%. No, you kind of make marginally better than what you would have invested in a let's say a customer who is at 15%, right? But you still you have that portfolio to get the right set of borrowers, make a lot of money. So that's the reason people kind of pick up some of those borrowers. But yeah, so that's the range in which we operate, and it's all using balance, and which means that 10% means if you're getting a loan of ₹1 lakh, you just pay 5,000 rupees for that. And not just that. So we've done a lot of daily loans, these kind of loans for micro SMEs, which is the need of the hour for them, right? So if they need the money in the morning to conduct the business, and by the evening they collect the cash and they are able to kind of give the money back. So we have partnered with certain organizations, created systems by which you push the money in the wallet, and the money is used for the business. And by the end of the day, when the money comes back to the wallet, the customer, the partner is able to kind of pull the money out. There we are able to deliver ₹1 lakh a day for 120 rupees. So those kind of things that is unheard of. I don't think so anybody is even trying to kind of do that, and that is only possible because we have a network. We have created a network. Lenders are super excited about reaching out to these micro SMEs and giving out loans at 100 rupees for ₹1 lakh for the entire day.
Okay, Mithun, over to you.
I think similar. We do fairly simplistic. Us a simple business. We give out loans with tenures of 12 months, 18 months, 36 months. Average ticket size is about 8.5, 9 lakhs. So you can get loans anywhere up to 1 to 3 lakhs, all the way up to 20, 30. But typically on average is about 8 lakhs. Depending on what we analyze of the bank statements, GST, etc., we give out anywhere between 15, 16, 17%, all the way up to 30, 35%. But it depends on a whole bunch of factors that the customer brings to bear. That's what we do. It's a fairly straightforward business in that sense.
Fair enough. On that note, I'd like to thank the 4 gentlemen. Thank you very much. And of course, 3 out of the 4 are representative of the future of the alternate financing space. So all the best, and hopefully, this alternate funding mechanism is going to get stronger as we go forward, and more small businesses will get funded by players like yourselves, making it a lot more robust as a sector. Thank you so much again.